Turkish Airlines presents Business Africa.
Hello and welcome to Business Africa with me, Ronald Kato. This week, the Belt and Road Initiative has helped bring billions in infrastructure and investment to Africa since 2013, but China appears to be applying the brakes on the program. Loans for infrastructure have reduced in volume, with Beijing emphasizing smaller projects. We assess the implications for developing countries. Also coming up, after being jolted by the recent political unrest, businesses in Senegal are relieved that President Macky Sall will not seek re-election in 2024. Government estimates say violent protests were costing the economy $33 million per day. Also, prices refused to drop in Nigeria as inflation remained on an upward trajectory in June. Stay with us for the details. Thank you for joining us. In the last 10 years, China has committed nearly $1 trillion to fund infrastructure and investments around the world through the Belt and Road Initiative. The program has made Beijing the biggest financier of infrastructure in Africa. But as the program marks its first decade, there's worry that China may be pulling back, moved by a debt pile-up and concern over its own economy.
Since 2013, China's Belt and Road Initiative has helped bankroll a boom in African infrastructure, allowing credit-starved countries to build railways, hydropower projects, roads, airports and communications. The initiative has also led to a surge in Chinese investment in areas such as manufacturing, mining and agriculture. But a decade down the road, some observers say the Belt and Road Initiative may be losing steam as Beijing becomes more risk-averse and the domestic economy struggles to go back to pre-pandemic growth levels. Statistics by China's Ministry of Commerce show that projects carried out under the initiative globally fell from their peak in 2016 to 5,514 in 2022. In Africa, Belt and Road funding fell to a historical low in 2022, amounting to just $7.5 billion from $16.5 billion a year earlier. Critics of the program have accused it of fueling a debt crisis in Africa, an accusation Beijing denies.
Kanye Lui is a partner and head of China at Pinsent Masons with extensive experience in international project finance. Thank you so much, sir, for your time. What do you make of the first 10 years of the Belt and Road Initiative, and how has it adapted to changes in the global environment?
What's happened over the last few years and since the peak in 2016 are a couple things. So the first thing is that during COVID, we all saw significant drops in loans. I think that's not surprising given COVID's impact on the ability to travel as well as general impact on business sentiments. There were, of course, also a number of fairly high-profile restructurings involving African countries as well as other borrowers. Overall, BRI activities dropped a bit, but the mix of what's happening also changed. Historically, I think most people think of BRI as EPC construction plus a loan from China. That's actually changed quite a bit in the last couple of years. So the mix of financings went from investments accounting to just about a quarter in the early days to now accounting for almost half. So now I think we're in a stage where certainly as at last year, 2022, investment and loans on the BRI are about half and half.
Kanye, Chinese lending to Africa has been dropping in recent years. How do you think it's going to evolve in the coming years?
I think there is a strong push for Chinese companies and lenders to be much more inclusive. So I think one of the hallmarks of the BRI type of financing you see in the last couple of years, in the earlier stages, was that Chinese lenders tend to prefer going alone. So they will go in, they do bilateral loans. I think now there's a very strong push for more banks to be involved, and in fact, the Chinese government actually call on the lenders to involve international lenders and multilateral institutions when making loans. So I think that's a really interesting development, and that's going to have an impact down the line.
Interesting. Many people think, Kanye, that the era of big Belt and Road projects is over. I'm talking about billion-dollar airports in Angola or billion-dollar railways in Kenya. Do you share this sentiment, and how do you think future BRI projects are going to look like in Africa?
We're likely to still see some, but certainly nowhere near as many mega projects going forward. There are a couple of reasons for that. So the first one is that certainly when it comes to Africa, I think debt sustainability is a worry. Okay, so for many countries, a mega project is never an easy undertaking. Right? It requires a huge amount of investment, even when you're getting financings from whether a multilateral lender or a Chinese lender. That has to be paid back. It is an investment, as anybody who's ever bought a house will realize that creates a burden. Second, a lot of the more sort of obvious mega projects are already done. So, they're there, or they're almost nearing completion. I think BRI is moving towards a phase where I think the focus is going to be on small and beautiful, right? So now that you've got a bridge, you've got the road, it's time to do business. So quite interestingly, over the last 3 years, the mix of BRI activity actually shifted from sort of the traditional infrastructure and energy to feature a lot more manufacturing.
The criticism that the Belt and Road Initiative has fueled a debt crisis in Africa, of course, the true picture is much more complex. But how can future projects be made to be more sustainable and bringing less debt to borrowers?
You always have to make sure you balance the need for investment against returns. So the resources are always finite. I think in terms of cost effectiveness, I think we're already seeing quite a push amongst many, many governments to require contractors and investors to take a long-term stake in projects. So, I think gone are the days where contractors will come, they will build the project and then they move on. I think now the expectation is very much that, once you build this, you're here to stay. I think that goes a long way in ensuring that the investors and the contractors have their interests aligned.
Kanye Louis, nice to have you. Thank you very much for your time.
Wonderful, Ronald. It's a pleasure. Thank you for having me.
Restaurants, hotels, bus operators, nearly every single business lost something during the political unrest in Senegal in early June. The damage to the West African country's economic output was estimated at $33 million per day. With President Macky Sall's announcement that he won't be seeking re-election next year, businesses are hoping to rebuild and to flourish.
The prolonged riots in Senegal have had a major impact on the country's economy. Employers estimate the losses at several millions of dollars. Among the hardest hit is the French retailer Auchan, which saw some 20 of its 39 stores looted between 2021 and 2023. The group, which employs over 2,300 people, is now struggling with the loss of uncertainty.
It's scary because in 2021, 19 of our stores were ransacked and we lost more than $25 million. So if there's always this context of tension, if there are attacks and theft in our stores, it's certain that we will have to close down in Senegal.
The main concern now is whether investors have been reassured pending the recent decision by President Macky Sall not to run for a third term in office. According to these economists, with the recent instabilities, the risks are still real.
It doesn't allow investors to guarantee the flow of their investment. So internally, there is a problem. Externally too, there is a problem of attractiveness. Senegal used to have a tradition of democracy, calm and so on. But with these demonstrations, it's true that there are issues. But there are still this insecurity, and that means there is an investment risk.
Major economic sectors have been impacted by these protests in Senegal. Big names such as BRT, valued at approximately $50 million, and even the regional express train, valued at $1.3 billion, have suffered heavy losses.
Now, inflation in Nigeria has not eased since the beginning of 2023. Prices continued to accelerate in June, following the end of a fuel subsidy in May. Inflation has been in double digits in Africa's biggest economy since 2016, eroding savings and incomes.
Nigeria's headline inflation rate accelerated for the sixth consecutive time to 22.79% in June 2023, according to data by the National Bureau of Statistics. In May, the rate stood at 22.41%. The figures may prompt Nigeria's central bank to tighten policy further when it meets to set interest rate next week. Last month's removal of a fuel subsidy helped escalate prices as transport fares shot up overnight. Food inflation accounts for the bulk of Nigeria's inflation basket and rose to 25.25% in June from 24.82% in May. The urban inflation rate was 24.33%, with rural areas sitting at 21.37%. Prices climbed fastest in Lagos and slowest in Ekiti State. A weaker naira could also keep Nigeria's inflation up as prices of imports remain high.
And that wraps up this episode of Business Africa with me, Ronald Kato. The news continues on air and online. Bye for now, and I'll see you on the next episode of Business Africa.
Business Africa was presented by Turkish Airlines.